Welcome to This Explainer. Today, we are tearing down the facade of Wall Street. We're looking past the standard charts, ignoring the noisy news headlines, and tossing out the basic economic data for a minute. Why? Because we're going to uncover the hidden operating system of the market. We're talking about the invisible, purely mathematical forces that are literally moving your portfolios behind the scenes right under your nose. Let's decode it. Now, we've all been there, right? You wake up, grab your coffee, check your portfolio, and boom, you're staring at a sudden, aggressive 2% drop out of nowhere. Naturally, you immediately scour your financial feeds looking for a reason, but there is nothing. There's no sudden European political crisis, the Fed hasn't changed policy, literally nothing happened in the real world to justify this kind of drop. It's incredibly frustrating, but here's the secret. This sudden movement isn't driven by human panic or perfect market chaos. Actually, the reality of modern markets is that they're regulated by numbers most people never even look at. They're moved by hidden operators who act strictly on math. The market isn't just some chaotic auction of buyers and sellers reacting to the daily news anymore. Instead, there's this hidden, highly mechanical force operating entirely behind the scenes. Think of it as a system built on strict mathematical obligations. We're talking billions of dollars being automatically deployed without a single human trader making a discretionary choice. And to really grasp how this system works, we have to look at a massive shift that happened just recently. Get this, 50%. In May 2022, the financial world fundamentally changed when 0 days to expiration, or 0 DTE options, were expanded to expire every single day of the week for the S&P 500. Today, those ultra-short-term options account for over half of all the volume on the largest, most liquid stock index in the world. Let that sink in for a second. Over half. This absolute flood of daily options volume has completely altered how the market moves. It amplifies small, everyday ripples into massive, destructive waves. And sitting right at the center of this storm are some very specific players. So, when you, or even a massive institutional fund, buys an option on the S&P 500, you are interacting with a market maker, also known as an option dealer. Now, here is the absolutely crucial thing to remember. These highly specialized institutions are not betting on the direction of the market at all. They make their money on the spread between the buy and the sell price. Their entire survival depends on remaining strictly 100% neutral.
And here is where the mechanical gears really start turning. When a dealer sells you a call option, they automatically take on the exact opposite risk. Basically, if the market rises, they lose money. So how on earth do they stay neutral? Well, they follow a strict mathematical mandate called the delta inverse rule. It goes like this. Step 1, they sell you the call. Step 2, they immediately carry directional risk. Step 3, and this is the kicker, they are mathematically forced to immediately go out and buy the underlying S&P 500 stock or futures to hedge that risk. This isn't a choice. It's a hard-coded obligation that triggers programmatic buying and selling.
Okay, to really visualize how they stay neutral, let's look at two key options metrics. Think of it like driving a car. First, we have delta, which is like your speed. It tells the dealer how fast the options price is moving relative to the underlying market. But then we have gamma. Gamma is the acceleration. It measures how fast your speed. The delta is actually changing. As the market price gets closer and closer to that options strike price, this gamma acceleration literally explodes. And this exploding acceleration forces dealers into a relentless process called dynamic hedging. This means they have to continuously buy and sell the underlying asset every few minutes, or even milliseconds, just to keep that neutral stance. Now, depending on the overall options positioning out there, the market falls into one of two distinct regimes. In a gamma-positive environment, dealers are mathematically forced to buy when the market dips and sell when it rallies. In this state, they act as a massive shock absorber, totally suppressing volatility. But when dealers find themselves in a gamma-negative environment, the math flips completely upside down. Now, they're forced to sell into market dips and buy into market rallies. They become an accelerator. So, in a gamma-negative regime, what would normally be a harmless 0.5% market dip gets amplified into a severe 1.5% plunge. Why? Purely because dealers are mechanically forced to sell right alongside the drop. So what does this all mean? It means if you really want to understand the current state of the market, there is one master key you need: gamma exposure, or what we call GEX. Honestly, if there's just one single number you look at every morning,
One metric that is arguably way more valuable than the VIX, more valuable than the daily news, and definitely more valuable than raw price action, it is gamma exposure. It doesn't tell you what investors are thinking. It tells you the sheer mechanical force that is going to act upon the market's price in the coming hours. It literally hands you the map of the playing field before the opening bell even rings.
Let's put this into perspective. Consider a scenario where gamma exposure sits at a massive negative $14.7 billion. What does a number like that actually mean for you and your portfolio? Well, it means that if the S&P 500 index drops by just 1%, market makers are mathematically and contractually obligated to immediately sell almost $15 billion worth of S&P futures. And again, they aren't doing this because they want to or because they think the market fundamentals suddenly look bad. No, they're doing it out of pure mechanical obligation to neutralize their risk. This dynamic creates an automatic, undeniable cascade of selling.
But hey, it's not all downside risk and market crashes. This exact same math creates incredibly predictable ceilings, too. Have you ever heard of a call wall? It's basically a price level on the chart where there is a massive concentration of positive gamma. Because of those mechanical hedging rules we just talked about, the market treats this level like a literal mathematical wall. Statistically speaking, the S&P 500 uses this exact level as resistance in 83% of trading sessions, and it completely fails to close above it 88% of the time. There's no magic here. That is just the undeniable weight of mathematical probability and mechanical hedging doing its job.
Now, you might be wondering, hey, can't I just look at where the most options are being traded and call it a day? Well, not quite. Looking at raw option volume is kind of like looking at a massive highway and seeing 100,000 bicycles. Sure, it's a huge number of vehicles, but they don't really wear down the road. That's what high option volume looks like when it's sitting really far away from the current market price. It has almost no gamma. But gamma weighting, that's like looking at that exact same highway and seeing 540-ton trucks. That represents a smaller number of zero-day options sitting right at the current market price. And trust me, those trucks absolutely dictate the flow of traffic. Gamma exposure tells you exactly where the trucks are, which keeps you from getting fooled by all those bicycles.
Let's actually apply this to a real-world scenario, one that unfortunately crushed a lot of everyday retirement accounts. Remember the August 24 cascade? Coming into August 5th, the Japanese yen carry trade was rapidly unwinding. Over in the pre-market, the VIX spiked to between 60 and 65. We hadn't seen levels like that since the pandemic crash of March 2020. But crucially, the market was in a deeply, deeply negative gamma exposure environment. So the moment the index started to slide, dealers were instantly forced to sell to cover their risk. This sudden selling pushed the market down even further, which forced the dealers to sell even more. It was a vicious cycle. This cascading mechanical feedback loop drove the S&P 500 down 5% in just 3 days, and a massive 8% over 4 sessions.
And we actually saw an even more extreme version of this mechanical trap play out in April 2025. In this case, the market broke down through a critical level known as the volatility trigger. This is the exact mathematical threshold where the entire dealer community flips instantly from being shock absorbers to aggressive accelerators. The mechanical result? The S&P 500 plunged 15% in just 3 trading sessions. I mean, think about that. A $50 trillion index dropping 15% in 3 days. A lot of investors were left totally bewildered because the traditional news headlines didn't match the severity of the crash at all. But for anyone paying attention, the explanation was perfectly written right there in the gamma data. Ultimately, understanding gamma exposure isn't about perfectly timing the bottom or perfectly predicting the market's every single move. It's really about fundamentally shifting how you view market mechanics. As this quote perfectly captures, the point is not to predict the future. The point is to know every morning if the safe door is locked or if it's wide open. By understanding whether dealers are acting as shock absorbers or accelerators today, you take back control from the invisible algorithms. So I leave you with this question. Tomorrow morning, right before the opening bell rings, are you going to be reacting to the chaos, or will you be checking the mechanics of the machine? Thank you so much for joining me on this explainer. Keep learning, stay curious, and I'll catch you next time.